Hello and welcome to the Scan the Markets live webinar with myself, David Madden. I'm a market analyst at Equity Capital in London, and Equity Capital is one of the many companies within the overall equity group. And so other companies within the wider organization include FXPesa in Kenya and also Equity Nigeria. So on today's webinar, what I'll be doing is like the ones I've done on previous Thursdays. I'll be running through 6 charts, big macro products. Some of them are currencies, commodities, indices, and talking about the kind of major fundamental news that's driving the markets, and also looking at some key, potentially important key price levels. Now, it is worth noting that anything that I'm covering in this live webinar should not be considered as investment advice or trading ideas. It's purely my own thoughts, views, opinions, and comments. If you have any questions for me throughout the webinar, feel free to just ask a question in the comment section or in the question section, in the Q&A section. If the question is relevant to what I'm talking about then and there, I'll probably actually answer the question then and there. If it's a question which I can come back to later on, that's most likely what I'll do. So I will be running through half a dozen markets myself, but after I've run through my kind of half a dozen markets, feel free to say, oh, you didn't cover this, would you mind commenting on this? And once again, I can't give advice. This is not to be construed as trading advice or ideas, just purely my own thoughts and comments. So first things first, looking off here at the gold chart, gold in US dollars. Gold, to be fair to it, has been trading in a smallish range or fairly narrow range recently. Let's call this the lower end of the range. Let's call this region here the upper end of the range. But more recently, it's been ticking higher. We've had a few updates in the last few days. Just to let you know, I'm looking at a 4-hour chart here. That's the time frame I'm looking at. That's the same time frame I'll be looking at across all the various different charts. And we can see, if you look at the price action on gold, the last few hours, the last kind of 24 hours, 36 hours or so, the gold market has been moving higher. Why is this? Well, partially down to the flight to quality effect. And if you're not familiar with the expression, it's a terminology used in the financial markets, where essentially, whenever traders are fearful about the state of politics or the state of the global economy, they look to purchase assets that are considered to be low risk. And gold kind of fits as a kind of classic safe haven play. Other safe haven plays, to a lesser extent, you'd have silver. To a lesser extent, you might have in the field of currencies, you might have the Japanese yen or the Swiss franc. But we've seen declines in stock markets around the world the last few days. What's going on here? We've been talking about the European Union are looking to impose new sanctions on Russia, particularly against Russian energy. We've already heard from the US looking at putting in new sanctions on Russia. Last night we had an update from the Federal Reserve, and that was actually fairly hawkish. The US Central Bank is already hiked interest rates last month, and it's open to the idea of having a 50 basis point or a 0.5% increase in interest rates once or twice throughout this year as a way of tackling high inflation. Now, that story about the Federal Reserve potentially having large interest rate hikes has put a bit of pressure on US stock markets. And as I mentioned, when people are worried about the state of the economy or the state of the stock market, if stock markets are falling, it's not unusual to see gold rising, which is precisely what we're seeing here. But there's also something else that's worth pointing out. If the central bank are becoming quite hawkish, that typically pushes up the value of their own currency. And we have seen a rise in the US dollar recently. Gold is listed in US dollars. Gold's traded in US dollars. And it says a lot about gold, the fact that it's been rising recently in the face of a hawkish Federal Reserve and in the face of a stronger US dollar. Earlier this morning, the US dollar index hit its highest, a new 23-month high, highest level in almost 2 years. So this is what I mean about, this is why I really like technical analysis versus fundamental analysis. People who only focus on fundamental analysis might say, if the Fed are becoming more hawkish, in theory, the US dollar will go higher and gold will go lower. Typically, and in terms of a textbook example, that actually makes perfect sense. But what we're actually seeing and translating in the markets is we're seeing gold actually move higher. So this is why I always ask myself, rather than saying, what do I think the markets are going to do? I look at the moves in the market and I say, what are the market moves telling me? Gold is moving higher in the face of a hawkish Federal Reserve. What does that tell you? That really says a lot. So I'm essentially, in that scenario, I'm essentially saying it's quite impressive the fact that gold is moving higher despite the fact the Federal Reserve is hawkish. So I think that is actually what actually says a lot about the strength of gold. You can see here on gold, it's reclaimed these three simple moving averages. If you look at the MACD indicator, it's ever so slightly in momentum, it's ever so slightly in positive territory, suggesting the bulls are in control. Looking at the RSI, it's moving higher, indicating that the price bias is to the upside. If we do see gold continue to hold above these three simple moving averages, and this short-term upward move does continue, we could be looking at retesting this zone here at 1949, and a break above that could see a target 1966. Now, it's worth noting, in the last few weeks, we have seen a decline in gold. You look at the price action here, we have seen a series, the peaks have been lower. So a series of a textbook definition of a downtrend is lower lows and lower highs. We are seeing lower highs, although we're not seeing lower lows. But it's worth noting, if the more medium-term bearish trend does continue, if gold doesn't in fact rally and clear 1949, if it continues to hold below these peaks here, it's possible the more medium-term bearish trend will continue. Should that be the case, we could retest this zone here, 1905 down to 1900, and then a break below that could see us back down towards the lows of late March around 1890. It's also one thing that's been playing into the mix for gold is it's often considered to be a hedge against inflation. Inflation in the US is running, CPI in the US is running at 7.9%, its highest level of 40 years. Inflation is rising in the United States, here in the United Kingdom, in the Eurozone, in many other countries around the world. And essentially, if your pay rise is only 5%, like essentially what it is in the US, but if your bills are going up by roughly 7.9%, you're worse off. And we're seeing that across many countries across the world. So some people often say, in a period of high inflation, purchase gold. This is some kind of a strategy that's been popular down through the decades. Essentially, the view is that rather than have money in your bank account essentially being eroded away in terms of real purchasing power, some people go out to invest in gold. So that's also a factor what's influencing the gold market. Looking here at the euro versus the dollar, the euro dollar currency pair, I mentioned about the Federal Reserve being hawkish. That pushed up the US dollar index to its highest level in 23 months, a new 23-month high, which explains why we've seen a broad decline in euro dollar recently. What's also impacting the currency pair is the fact that the Eurozone is very heavily dependent on Russian energy. Major economies, something like 40% of all of Europe's energy comes from Russia. In major economies like Germany and Italy, the first and third largest economies in the Eurozone, they have their gas imports from Russia account for 55% and 45% respectively. So 55% of German gas imports come from Russia, and in Italy it's 45%. They're heavily dependent on Russia along with other Eurozone economies. The fear is what's going to happen? Is Russia potentially going to cut off supply? Will the European Union look to actually have a deliberate plan to actually start phasing out the purchase of Russian gas and look to get the sources elsewhere, potentially end up paying more for their gas? If they're end up paying more for gas, that's going to have a knock-on effect with businesses and those relevant economies. So the euro itself is under pressure because of what's going on in Russia, in Ukraine, because of the Russian invasion, and the US dollar is rising itself because of the overall hawkishness of the Federal Reserve. To an extent, the US dollar from time to time can act as a bit of a safe haven play, i.e., when stock markets around the world are falling and people don't want stocks because they're considered to be higher risk, and they want to hold an asset that's deemed to be low risk. To a lesser extent, the US dollar is actually as a bit of a safe haven play as well, but not to the same extent as I say, the Japanese yen, the Swiss franc, or gold. So you can see here, euro dollar has recently fell to a level last seen in early March, essentially at a 1 month low rather. The fact that it recently hit a 1 month low really tells you everything about how bearish the recent move has been. Looking at the price action here, we've had a few attempts to try and break higher and try and move above the 20-period moving average. We didn't even have a decent break above the 20-period moving average. These three moving averages that I have on screen here are the 20-period moving average, the 50-period moving average, and the 100-period moving average. And while we continue to hold below those three moving averages, it's likely the more kind of recent bearish trend will continue. Moving lower from here, we kind of retest the lows in March in at one spot 0805, which I believe is a 2-year low. We're quite close to a 2-year low. And if we break below that, we then be creating a new, multi-year low or close to a multi-year low. And should we go break below that level, we can then be looking down towards one spot 0700. Now, if you take a look at the price action, it's off. It's just about recovered from its recent lows. If you look here at the RSI, it's no longer in oversold territory, suggesting that the kind of selling pressure was quite severe here and it's eased up a little. So if we do see a continuation of if we can hold above the recent lows, and we do see a bit of a rebound or a rally in euro dollar from here, we could look to encounter resistance from this simple moving average here, the 100-period moving average, in at one spot 1014. And the reason why I picked this moving average is because if you follow it around, you can see it acted as a resistance point here. It essentially acted as resistance points along here and here as well, and also along here back in late February. So what I often say is, if a metric has been of importance in the past, it makes it more likely it'll be of importance in the future. And I say a metric as in, it could be a moving average, it could be a particular price zone, it could be a consolidation area or a support or resistance area. It could also be a trend line, or it could even be like a big number, like euro dollar 110 or 120 or whatever it is. So it's worth your while looking at where has the market often had, which have been significant price points previously, because chances are that's where some people anyways, will be having, be it their stop losses or their limits to take profit or whatever it is in future. And that's why, in a way, it can become a bit of a self-fulfilling prophecy. But if you do break above one spot 1014, where can we go beyond that? Well, we could be looking for these peaks here in around one spot 1131. Taking a look now at the US 500, the S&P 500, the market enjoyed a very impressive rally between mid-March and late March. In fact, the highs that it posted in late March, I believe, were levels on par. We're on par with levels last seen. I think it was in January. Yes, back up the levels last seen in mid-January. So the highs we saw in late March were basically the highest level seen in mid-January. So we're talking about a 10-week high was posted only a few weeks ago. Keep in mind, a 10-week high was posted all the while there was chatter about more sanctions and the ongoing war in Ukraine. There was a 10-week high was posted in the face of an ever-increasingly more hawkish Federal Reserve. So it really says a lot about how strong that rally was. The fact that it was rising despite all of the other negative news in the ether. Now, this is also a good example of why, comparing fundamental analysis with technical analysis, the fundamentals on paper look bad because they are bad, but the market kept on going higher. And this is why I've learned the mistake myself. Don't start saying to yourself, oh, the market should go down, therefore I'm going to start shorting it. I would look at what the market's actually doing and say, what is the market telling me? As you can see here, the market enjoyed a very impressive rally here. Yes, in the last couple of weeks, I can see we've had a pullback, and we've since then we've seen the lower low, the lower high, the lower low. But keep in mind, look at the ground we've traveled. The market hit a 10-week high here. The lows that we've seen in the last few hours, they didn't even look to retest the lows of kind of late-ish March. If you look at these potential zones of support here, an old resistance area here, a support area here, in around kind of 44.21. The broader uptrend in the US 500 is still very much in play, even though we've had a fairly large sell-off or pullback in the last week or 10 days. To be honest with you, in the near term, while we hold below these three moving averages, I think the kind of short to medium term bearish trend will continue. Moving lower from here, I think we could head back towards 44.23. Right below that could see us back down towards 43.75. To be honest, it's only really what I look to, if we break below 43.75, but then I begin to think to myself, you know what? Maybe the overall trend is coming to an end. Maybe the overall, because let's face it, if you look at the lows that were set here in mid-March, we rallied something like about 500 points. We had a huge rally. We went from 41.40, let's call it, up to 46.40 with a 500-point rally. That's a huge rally. It's a rally in excess of 10%, in a matter of 2 weeks. So don't be surprised if you rally 500 points. Don't really be surprised if you drop back, say for example 200 points where we are now, or perhaps down around say 250 points of a drop, which would take us back down towards kind of below 44.00, 43.85 thereabouts. So markets down theory tells us that most pullbacks tend to be between 1/3 and 2/3 of the preceding move. So we rallied 500 points here. It's not unusual to try. It's not unusual to see a pullback of 250, even 300 points. So in the medium term, I think we could go lower, but be mindful of the fact that we might see some buyers step into the fold around 44.23, 44.00, or 43.75. If they get a broader upward trend does continue from here, we could be looking at retesting this moving average here, the 50-period moving average. As you can see, it acted as support here, it's a support zone here, a resistance zone here. That comes into play around 45.28, and a break above that could see a target this zone here around 45.93. What's the kind of the fundamental story? We pulled back from the peak. We had a 10-week high. We've been pulling back for the last week or two, but it seems to me the broader uptrend is still in effect. Hawkishness from the Federal Reserve, and it's also to do with the US 500 has a fairly large composition of tech stocks. This is one of the kind of major themes in the markets right now. If the Federal Reserve they've already hiked interest rates once by 25 basis points by 0.25%. It was a well signaled hike. And if they do hike interest rate, if they continue to hike interest rates at a fairly rapid pace over the next 6 to 9 to 12 months, all of a sudden companies which have fairly high levels of debt might come under a bit of pressure, because for the last, excluding the most recent interest rate hike, interest rates in the United States have been essentially zero. So therefore, companies with fairly high levels of debt have managed to get by okay. Individuals with very high levels of debt have managed to get by okay. All of a sudden, if their cost of borrowing is going to go higher, and that's likely to get eaten into their profit margins. Although there are some tech stocks like Apple, which have oodles of cash, hundreds of billions of dollars in cash, there are some companies in the tech sector that are relatively high levels of debt, because for some people in the tech sector, the name of the game is all about what the company is going to be in 5 years, 10 years when it takes over a particular market. But for the time being, they have relatively high levels of debt compared with traditional businesses, be it banks or be it energy companies or be it retailers. So the kind of view in the markets is that whenever there's this fear is about higher inflation, not only do stock markets in the US generally fall across the board, but the tech sector itself falls a fairly large amount. And in turn, the NASDAQ 100, the UT 100, and also there's a fairly large few large tech stocks within the makeup of the US 500. So that's something to be mindful about. Coming on now to the UK 100, one of the kind of more popular European stock markets. The UK 100, like all the stock markets, has peaked, pulled back from its recent high. But if you take a look at the price action, like other markets, even more so, since the first week of March rather, the UK 100, the FTSE 100 has been enjoying a fairly impressive rally. Keep in mind, we went from in the region of 6,760 all the way up to around 7,600. So we rallied about 900 points in the space of a month. And we haven't, even though we've had a few pullbacks, such as here, we haven't had any major declines. So it's still in the broader upward trend. We're holding above all three of these moving averages. So while we hold above those metrics, it's likely the broader upward rally will continue. Moving higher from here, I'm looking towards 76.88, and then beyond that up towards 77,700. If you take a look at the RSI, it's essentially in the middle of the range, suggesting there's no strong price bias in our direction. Looking here at the price action recently, it's pulled back from its recent peak. If you do see further declines in the UK 100 from here, where we potentially find support, well, perhaps from this simple moving average here, you can see that actually a support here, resistance here, didn't quite act as resistance here, but actually a resistance here. So as a pretty good history of acting at resistance. So it's possible that old resistance might become new support. And that comes into play around 74.86. And a break below that could see us back down toward this zone here at 73.85. Now, why has the FTSE 100 done fairly well? Well, the FTSE 100, geographically and economically, it's less exposed to Russia. So even though the British government has come up with some pretty tough sanctions against Russia and certain individuals, in terms of energy-wise, it's not in the same boat as, say, Germany is or Italy is, who have a very large dependence on energy from Russia. You know, the market's rising in the face of a hawkish Fed. That can underline how strong the market is. But commodity stocks is the reason why the FTSE 100 is doing fairly well. Because Russia is essentially a commodity superpower. It's a huge producer and supplier of oil, gas, and also various different metals. Countries around the world and companies around the world are looking to not deal with Russia. And with that, there are supply concerns for minerals, for commodities across the board. And therefore, commodity prices have been fairly high. And in turn, commodity stocks have been high. So mining companies and oil companies have outperformed in a fairly bleak market run recently. So the fact that there's a fairly high percentage of commodity stocks in the FTSE 100 has helped the market. Looking now at US oil. So US oil, we had some of the heat taken out of the oil market, whereby we've had the United States announce plans to dip into its strategic oil reserve. We've also had the International Energy Agency talk about releasing oil stockpiles from its strategic reserves as a way of taking the heat out of the energy market. Why are they doing this? Because oil is, US oil, WTI is around $96 a barrel. Brent crude is over $100 a barrel. High energy prices lead to high inflation. High inflation usually causes central banks to hike interest rates. Higher interest rates usually puts the brakes on economic growth. And if you put the brakes too much on economic growth, demand not only kind of diminishes, it can fall off fairly. It can, if you get it wrong, can fall off fairly large. And then what happens? Demand for oil falls. So oil-producing countries have to strike a balance. They want a fairly high oil price, because that's good for their revenue, but they don't want it so high that it eventually destroys demand. So if you look at the price action recently of US oil, we haven't had any really tough sanctions against Russia in terms of oil. Sure, we've had announcements about looking at kind of weaning away off it and the likes, but there's been no really brutal stuff like, as of tomorrow, we're stopping all imports from Russia. The problem is that globalization and economies are so integrated, it'll take you a while to find an alternative energy source or an alternative energy provider before you can do these things. So there hasn't been any brutal, extremely harsh sanctions against Russia in the oil area as of yet. So we've seen a move lower in the price of oil because the really high price, when we saw oil up around 124, 125 back in early March, the fear was people are just going to stop buying Russian oil outright. That hasn't quite happened. Hence why some of the fear has been fading, and in turn, the price of oil has been fading. So recently, we fallen to a level last seen in mid-March, back to about a 2-week low. We're well below all three of these moving averages, so the kind of broader bearish trend is still in effect. RSI is moving lower. MACD indicator shows that momentum is in negative territory. If you move lower from here, we could hit the target 89.57, and a break below that, you can see it's down towards 87.62. Now, if you do manage to get a stage of rally from here, we first have to kind of overcome this moving average here, the 100-pin moving average. It acted nicely as resistance here. You can see that actually as a support point here, a resistance point here, a support area here, and a support area here. So as a pretty good track record of being a significant metric. And as I said, metrics that have been important in the past are usually not always, but can be important in the future. A rally from here could see some counter resistance at 102.70. Break above that could see a strike at this peak here around 107.68. Coming on now to the Australian dollar versus the US dollar. Earlier this week, excuse me. Earlier this week, we heard from the Reserve Bank of Australia, and the Reserve Bank of Australia basically issued a fairly positive outlook for the health of the Australian economy, and in turn, that pushed up AUD USD to its highest level since June last year. So essentially talking about a 9-month high, perhaps even close on a 10-month high. So back to AUD USD hit a 10-month high during the week. It really tells us how bullish that currency pair is. On top of that, the AUD USD was rising in the face of a strong dollar, which also adds weight to the view the Aussie dollar is strong. I mean, if the Aussie dollar can hit a 9-10-month high against the US dollar, when the US dollar is basically itself at a 2-year high, it really highlights how strong the Aussie dollar is. In the last couple of sessions, what have we seen? We've seen an overall risk-off mood. The Australian dollar falls into the bracket of a risk-on currency. Risk-on means people are willing to take on more risk. They're optimistic about the health of the global economy, or they're optimistic about a certain country, and therefore they want to buy up those, be it that country's currency, or buy stocks in that country, or maybe perhaps just they're optimistic about what's going on in the world in general. Risk off is what I talked about earlier on, where people sell stocks and buy low risk assets. Risk off currencies would be the Japanese yen and the Swiss franc. Risk off plays or risk off strategies would include buying gold, for example. So what have we seen in the past 48 hours, 72 hours? What have we seen? A bit of a pullback in the AUD USD. Not surprisingly, if you hit a 9-10-month high, at some point you're probably going to have a bit of a pullback. Some people will cash in their long positions. Some people might open fresh short positions because they feel it's a bit overstretched. But the broader upward trend, as far as I'm concerned, is in effect. You know, if you take a look at the price action the last couple of days, we've seen a bit of a pullback in metals, industrial metals like copper and silver, because of when they've declined a bit. In turn, that's put a bit of pressure on the Australian dollar. Why is this? Australia has a fairly large mining sector. They're very resource and mineral rich. So when metals are booming, it tends to push up the value of the Australian dollar. When metals fall, it tends to weigh on the Australian dollar. So keeping in the very short term, we can see here that we've had a move to the downside in AUD USD the last few days. Looking at the MACD indicator, momentum swung from positive territory into negative territory, telling us the bears are now in control. Excuse me, the RSI has been moving sharply lower. So it's not unusual to see a bit of a pullback after you've hit a 9-10-month high. But notice how the lows that we set in the last few hours, we didn't even actually trade below the 100-period moving average. We got close to it, and the lows that we set here in the last few hours are not too far away from the lows that were set here or the peak that was set here. Look at this entire zone here. A peak here, a low here, a low here, a low here. You know, it's a good example of, once again, an important price zone here in around 0.7460 thereabouts. Acting, you know, that zone was important in the past in terms of resistance on the way up. That acted as a support level a few times. It's acting as a support level again. So if we could, my view is if you could hold above that metric, and if you could hold above this moving average here, I think the broader rally will continue. If we do manage to rally from here, where can we target? 0.7660. Gonna break beyond that. Could see us target 0.7700. If we do see a break lower and we take out this area here in around kind of 0.7460, should we drop below the 100-period moving average, we can then potentially back down toward this area here around 0.7374, or back down toward this area here around 72.82. I have a question here about how should I analyze new trends and emerging issues. I'll come on to analyzing trends now in a second. I'll just quickly kind of wrap up the sixth market that I've kind of planned to talk about this evening. But if you do have any other markets you want me to discuss, feel free to just kind of put it in the chat box or the question section. This here is the D30, the German stock market. As I've talked already about what's going on with the Eurozone, Germany is very heavily dependent on Russian natural gas. If we have kind of further sanctions on Russia and its energy, that could impact the German economy. So Germany is sort of kind of in the front line, as it were, when it comes to new fears about Russia. Hence why we've seen a move lower excuse me, in the last few days from on the DE30. It is worth noting though that in late March, around this time last week, or maybe 10 days ago, the DE30 hit a 1 month high. So once again, like with the S&P 500, if you rally for the guts of 1 month, don't be surprised if the markets pull back a few hundred points. You know, starting from the lows here of early March up into the highs from the lows of late March to the highs of late March, the market rallied over about 2,500 points. It was a huge move. So if you rally 2,500 points, don't be surprised if you drop 1,000 points, 2,000 points, maybe even 2,500 points. Like I said, Dow theory says that the majority of pullbacks tend to be between 1/3 and 2/3 of the preceding move. So 1/3 of, if you're to pull back 1/3 from the rally of 2,500 points, that's a drop of over 800 points. And then if you were to have a 66% retracement of a 2,500 point move, that's a decline of more than 1,600 points. So the kind of big picture trend for the DE30 is still higher. Although in the short term, we have seen a lower low, a lower high, a lower low. We're below all three of these moving averages. Momentum is just about in negative territory. The RSI is at the lower end of the range, even though it's moved a bit higher recently. Excuse me. If the DE30 continues to hold below these three simple moving averages, I think the recent bearish trend will continue moving lower from here. If we break below these lows here, I'm looking down towards 13,576. And a break below that could see us down towards 13,276. Like I said, the much longer term trend is higher. So if we can manage to kind of clear these three simple moving averages, that could be a sign that the market's turning around and that the broader bullish trend is continuing. Rallying from here, we could target 14,605. At a break above that, could see a target 14,732. So I have a question asking about NZD USD, which I'll come on to now in a second. But before that, in relation to, and also it's a bit of a vague question, how should I analyze new trends and emerging issues? In relation to that question, I'm a big fan of technical analysis, the study of charts. There's a book by John J. Murphy on technical analysis. It's basically regarded as probably the best book on technical analysis, or at the very least the best introductory book on technical analysis. It talks all about kind of price patterns and what's going on, and the definition of an upward trend, the definition of a lower trend. It's a difficult question to answer in a very short space of time. How should I analyze new trends? I would read up about Dow theory. Dow theory talks about as a few tenets to it, a few kind of key principles, a few tenets to it. And one of the key principles is that a trend will remain in effect until you see a significant move in the opposite direction. What defines a significant move? Well, that's why trading is hard. But there's also, talking about how there are trends within trends. So there'll be an overall arching trend, there'll be a medium-term contra trend, there'll be a short-term trend as well. So I'll try and find you a good example of what I'm looking for. So in this instance here, we can see from January onwards, in this time frame here in the kind of mid-January, the DE30 was basically at an all-time high, an all-time high. And what do we see since then? We've seen a lower low, a lower high, a decline, a lower high, a lower low, a lower high, a lower low. So this is just a good example of just looking at the price action going, what is the price action telling me? We're seeing when the market falls, it creates lows that were lower than the previous lows. This low here was below this. This low here is below this. This low here is below this. When the market rebounds off a new low, it doesn't go back to retest the previous peak. In this case, it'll drop maybe say 200 points. It'll only bounce back 100 points. Then it'll fall another 200. It'll bounce back 100. It'll drop 250, so on and so forth. So this is how I can analyze the markets. And I'll always just look at it and go, what is the trend? Is the trend higher? Markets can do only three things: go up, down, or stay the same, or trade in a range. So I'll always be asking myself the question, what are the markets telling me? And I strongly advise everyone, particularly if you're new to the financial markets, read about technical analysis, read within the kind of topic of Dow theory, and I strongly recommend getting that book. technical analysis. I think it's a technical analysis on the financial markets by John J. Murphy. I've got a question here about NZD USD. Any of the markets you want me to take a look at, feel free to just put it in the chat box or the comment section, and I'm happy to take a look at it. So this is one of the kind of habits I've gotten into. I've already in this webinar I've talked about how the US dollar recently hit a 23-month high. So in my own head, even before I look at this chart, I'm half expecting NZD USD to be lower, because if we talk about the overall strength in the US dollar, in theory, the currency pair that has the currency pair NZD against the dollar should probably going to be lower. That being said, New Zealand is a big agricultural and a big commodity exporter, mostly on the agricultural products side, as you know, corn, wheat, and milk and whatnot, versus say Australia, which is much more on the metal side. And we talked a minute ago as well about how the Australian dollar hit a 9-10 month high versus the US dollar. So to be honest, also Russia is a huge exporter of wheat, as is Ukraine. The fears is there's going to be massive food shortages. So, you know, even though I said what I said about the strength of the US dollar, I wouldn't be surprised, even before I look at this chart, if we see NZD USD in a similar price pattern to what's going on with Aussie dollar. Now, let's see what it turns out to be the case. And it is fairly similar. We're now looking at NZD USD, and lo and behold, what I've said, the kind of prediction I made about, I wouldn't be surprised if the price action is quite similar to Aussie dollar turns out to be true. And look at this. We recently hit a high last seen in November last year. So we're talking, we're not talking about a 3-4 month high. Once again, the New Zealand dollar is broadly moving higher. So if you look at the price action here, as I mentioned, what is the market doing? Higher high, higher low, 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 higher high. Fair enough. The low that the lows that we set here broke below this low are essentially kind of on par with this zone here. So even though, you know, the broader upward trend is still in effect, I would be surprised in the near term if we lose a bit further ground. So I was asked a minute ago about how do I analyze the markets. I always ask myself, what's going on? I don't ask myself and go, oh, well, you know, the market should be doing this. I learned from that mistake. The market does what it does, and it's my job as an analyst to kind of to identify the trend and essentially piggyback on the trend. So we can see here, we've recently hit we're now basically the highest level since November. We're talking about a 4-month high, you know, 4 or 5 month high was recently racked up at NZD USD, telling me the kind of broader picture is strong. Fair enough. We've had a reasonably large pullback, whereby we dropped back to a level last seen about a week ago or 10 days ago. That's really surprising. You know, if you have a multi-month high being, if you rally for say several months straight and you hit a 4-month high, you're probably going to see a bit of a pullback at some point. And even then, the pullback we've seen isn't huge. So in the short term, while we hold below these 3 moving averages, I think the near term bearish trend will continue. Moving lower from here, we could head back down towards 0.6863, or perhaps down toward this area here around 0.6765, or a really big area to watch out for will of course be this low here in mid-March in around 0.6727. But if they get a broader upward trend, it continues, and we can manage to kind of hold above these zones here, you know, I should potentially put in this zone here. It's not a surprise to me at all that this point here, actually a resistance point here, the market retreated as it does, has a strong rally, finds support from it as a rally again, finds support from it again, rallies, doesn't go all the way back there, but gets very close to it, and then rallies again. So I've identified, in my opinion, this is a fairly significant area. It comes into play in around, you know, that's in around 0.6870. If you can hold above that area, or if you fall only a bit below it, I think the broader upward trends are going to continue. Then I'll be looking to retest the recent peak of 0.7335, beyond that up towards 0.71, 0.72, and so on. I'm just conscious now of the time. We've been going for about 40 minutes. Are there any other markets you want me to look at? Any other questions or comments about what I've covered so far? I'll happily look at one or two more charts. I just don't want to be in a scenario. I just basically, I'm concerned about time. I don't want to be kind of talking for too long because people's, people got places to go and things to do. Comment here. Technical analysis on the financial markets, a comprehensive guide. Yes, by John J. Murphy. Yes, that is the book. That is an absolute book again. That's what I'm referring to. That title the individual made the comment about that. Technical analysis of the financial markets, a comprehensive guide by John J. Murphy. That's the book. That's the book that I read several years ago, and I remember thinking to myself when I read it, why didn't I read this sooner? So for me, I'm now at the point, for the first few years in my time in the financial markets, I was a big follower, and I still am, of fundamental news, because it's always good to keep abreast of what's actually going on. but the more time goes on, the more I actually think that technical analysis is more important. Why? Because there are plenty of examples of where the market has a certain move, but the fundamentals don't match it, and the market does what it does, and you can turn around, because a market is essentially just a group of individuals who are all trading. And if you say in theory the market should go down, but if essentially everyone else in the room believes the market's going to go up and really wants to buy the market, they're going to push it higher. And you will see examples of this. Like, for example, here, coming back to it, the S&P 500. The S&P 500 had a 500-point rally from mid-March up until late March in the space of 2 weeks. A rally in excess of 10%, despite the fact that a war was going on in Eastern Europe, despite the fact that there was higher and higher inflation, and despite the fact there was talk of the Federal Reserve hiking interest rates. All this went on, and yet the market still went up. So the old me would have gone, the market should go down because of all the negative news, and start shorting the market. But the new me now going to go, you know what? Ask myself the question: what is the market doing? Especially with the individual, ask the question: what's the best way to analyze the markets? The best way to analyze the markets is look at the price action and ask yourself the question: what are the markets doing? I've got an individual here asking about euro dollar, which I've covered already, but I'll come back to it again one more time, and then I'll have to wrap things up, because I'm aware I've been talking now. I've been taking up about 44 minutes of your time. Euro dollar has been trending low for two reasons. First of all, the Eurozone is very heavily dependent on natural gas from Russia, and coal and oil as well. So talk of the Eurozone weaning its way off Russian energy, be it in the form of new suppliers or embargoes or whatever it is, has hurt the euro itself. Also, what's going on, the US economy is quite strong. Unemployment in the US recently fell to a new 2-year low, and the United States recently hiked the US Central Bank, Federal Reserve, recently hiked interest rates. We heard last night that they might even have larger than usual rate hikes in the future as a way of tackling high inflation. So the dollar is strong and the euro is weak. That combination has put downward pressure. For those of you who are brand new to the financial markets, when you look at a currency pair, euro dollar, it's always the first currency you trade. If you buy euro dollar, you're buying euros and you're selling the US dollar. If you sell euro dollar, you're selling the euro. It's always the first currency mentioned is the one you're actually trading in. And then in this case, if you sell euro dollar, you're selling the euro and you're buying the dollar. Euro dollar has been trending low recently, only if it is in the last 2 hours. We've fallen to a level last seen basically 1 month ago. People ask me, how do I analyze the markets? A 1 month low tells me sentiment's bearish. Look at the price action here. A clear example of a downward trend. We're holding below these 3 moving averages. I think while we do, I think that the broader bearish trend will continue. Moving lower from here, I look towards 1.0805 and a break below that down towards 1.0700. If we do manage to get a snapback or a rally from here, where can we counter resistance? Well, potentially from this simple moving average here in around 1.1014 and a break above that up towards 1.1131. That's all it. That's everything now for this evening's webinar. Please feel free to kind of sign up for next week's webinar, and also every Thursday and also every Tuesday, myself and my colleague Mohammed Shanti will be hosting these live sessions. If there's any kind of questions or comments you have, feel free to share them. If you're in contact with your account manager, be it FX Payza or Equity Nigeria, feel free to kind of pass on any feedback, and then they can pass it on to me. Before I go, we can look here. For those of you who are on Twitter, feel free to follow me on Twitter and also contact me on Twitter as well. I tweet throughout the day. My Twitter handle is @dmadden, MADDEN _equity. I have the equity branding here. Also, the FX Payza have a Twitter account as well, so feel free to follow FX Payza. Like with what I mentioned in tonight's webinar, I can't give it trading ideas or investment advice. But if you ask me a question, I could talk about the kind of broad trend in the market, and I could mention price points which could be significant in the future. For those of you that stayed to the very end, thank you for your patience. 47 minutes on, and I'll look to wrap things up there. And everyone, have a good evening and have a good night. Take care. Bye now.